Hello friends, welcome to Sundari Mutual Fund's monthly debt market update. The month of February started with big events like Union Budget, US Fed policy, and RBI monetary policy. While the first two events were positive for the bond markets, as the borrowings announced in the Union Budget were less than what markets feared and largely in line with the market expectation. At the same time, US Fed policy was also less hawkish than what market feared. However, the RBI monetary policy was relatively hawkish than what market expected. Though the rate action from the RBI was in line with the market expectation, however, no change in the stance or since any indication on future rate hikes being highly data dependent or RBI being closer to the end of rate hike cycle was something which a downer for the market and market reacted negatively. RBI MPC, though acknowledged the recent fall in the inflation, also highlighted the risk from continuing high sticky core inflation. The data printed during the month didn't help either. The CPI print during the month came at 6.5%, good 0.5% higher than what market was expecting. This was largely due to the rise in the cereal prices like wheat. On the other hand, GDP data print was marginally softer than what market was expecting. However, this was partly attributed by the sharp change in the previous year's economic data by the government. Going ahead, domestic inflation is expected to be in 5 to 5.5% range and domestic growth around 6% range. If we look at the high frequency data indicators such as PMI, tax collection, they also indicate the continued robust domestic activity, economic activity. Though on the global front, if you look at uh, the economic data remains stronger, economic as well as the job data remains stronger than what markets was expected post the recent rate action by the advanced economy central banks. At the same time, uh, the fall in the inflation which we have been seeing over the last few months seems to have slowed down now. And if you look at the recent data prints, the inflation data have print marginally higher than what the market was expecting or somewhat closer to the previous number. So maybe the inflation reduction journey from here onwards seems like it's going to be not that quick as we have been seeing over the past few months. Going ahead, looking at the interest rate outlook, we believe while the domestic inflation outlook, which is around 5.5% for next 9 to 12 months ahead inflation, and the current RBI policy rate also at 6.5%, should not have leave much room for RBI to act on the either side. However, this outlook will continue to be shaped up by the ongoing development on the domestic monsoon and the global commodity food and energy prices, the ongoing geopolitical developments, and the rate action by the advanced economies. As all this will also impact the domestic inflation as well as the exchange rates, which RBI is quite wary of. Accordingly, we believe that given this outlook and uncertainty and the shape of the interest rate curve, which is completely flat, the opportunities on short to medium tenure of the curve looks opportune or best on risk adjusted basis for most investors. Accordingly, investors can choose to invest depending on their investment horizon. For example, investors looking for 3 to 6 months can uh, can invest in ultra short duration category of fund, whereas the investors looking for 6 to 12 month kind of investment horizon can look to invest in low duration or money market strategies. Similarly, investors looking for 1 to 3 year duration can uh, look for actively managed short duration fund, corporate bond fund, and banking and PSU categories. Investors looking for 3 year or more can look for products like target maturities or short duration product. Investors looking for very long term horizon can look to invest in long duration funds in a staggered manner to take advantage of the opportunities offered by this ongoing volatility in the bond markets. With this, we'll wrap this edition. Thanks for watching. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.